Did you know that inflation affects the prices of things we buy every day? It's like a slow but steady increase in the cost of goods and services over time. For instance, if your favorite snack cost $1 last year and now it's $1.02, that's a glimpse into inflation. Inflation is a bit of a mixed bag. It can mean fatter paychecks for workers to match rising prices, but can also be tough for folks on fixed incomes like retirees. We're diving deep into understanding inflation, what it is, how it's measured, what makes it tick, and how investors can handle it. Stick with us, and you'll become a pro at understanding inflation. Come along on this informative ride. Subscribe for the full video. If you're curious about how inflation affects your wallet, hit that thumbs up and let's decode this economic puzzle together. So, what exactly is inflation? Absolutely. Here's a revised explanation. Inflation is like a slow climb in the prices of things we buy. Think about your favorite snacks getting pricier each year. It's usually measured as a percentage, showing how much prices have gone up over time. So, if last year a toy cost $10 and this year it's $12, that's a sign of 20% inflation. Now, why does it matter? Well, when prices go higher, your money doesn't stretch as far. You might notice you can't buy as much with the same amount of money. This can make it tough for everyone to afford the things they want or need. Businesses also feel the pinch. They want to raise prices to cover their own higher costs, but if they make things too expensive, customers might go elsewhere. So they have to be careful about balancing their prices. In the end, inflation tells us how healthy an economy is. Too much can cause problems, but too little might mean people aren't buying enough. So finding the right level of inflation is key to keeping an economy running smoothly. How is inflation measured? To figure out how fast prices are going up, economists use something called the Consumer Price Index, CPI. Think of the CPI as a big shopping list that tracks how much stuff like housing, food, healthcare, and transport costs. This list gets updated every month by the Bureau of Labor Statistics, BLS. The CPI helps find the inflation rate, which shows the percentage change in prices from one month to the next. For example, if last month the CPI was 100 and this month it's 102, that's like a 2% increase in prices over a year. But wait, the CPI doesn't cover everything we buy. It's like checking prices for some stuff, not everything. Still, it's a good way to figure out how much prices are rising overall. Now, why do prices go up? Well, there's one common reason. When there's more money around but not enough things to buy, prices tend to rise. It's like if suddenly everyone got more money but there weren't more toys or snacks available, the prices for those things would shoot up. Understanding how they measure inflation helps us make smarter decisions about money and the economy. So, by keeping an eye on how prices change, we can make better choices about what to spend our money on and how to manage our finances. What causes inflation? Let's dive into the three main types of inflation. Type 1. Demand pull inflation. This happens when there's a surge in demand for goods and services, but there aren't enough of them available. Imagine everyone suddenly wants the same item, but the stores can't keep up. Prices go up because there's more money chasing after fewer products. It often occurs during times of robust economic growth or when it's easy to borrow money due to low interest rates. Type 2. Cost push inflation. Here, businesses increase prices to cover higher expenses, like paying workers more or dealing with increased costs for raw materials. For instance, if there's a drought affecting crops or a sudden spike in oil prices, businesses need to charge more to balance these higher costs, leading to overall price increases. Type 3. Built-in inflation. This type occurs when workers demand higher wages as living costs go up. When companies then raise prices in response to increasing labor expenses, it starts a cycle where higher wages lead to higher prices and vice versa. This loop can widen income gaps. reduce the purchasing power of regular folks, and even lead to higher interest rates and slower economic growth. While built-in inflation might seem normal, if it gets too intense, it can create serious problems for the economy. It can make it harder for average people to afford things, affect interest rates, and even slow down the growth of the economy. Understanding these types of inflation helps us see how changes in prices impact our wallets and the broader economy. Investor's Guide to Inflation. Predicting when inflation will stabilize remains uncertain, but it's crucial to realize that inflation isn't always a negative force. Surprisingly, inflation might offer a chance to reassess your investment strategy. Understanding how various investments respond during high inflation is key. Let's delve into how different types of investments fare during periods of heightened inflation. Stocks. Historically, stocks have shown resilience during high inflation periods. Companies can offset increased costs by raising prices without significantly impacting consumer demand. As long as corporate profits remain robust, stock prices often continue to climb despite rising consumer prices. Among various types of stocks, value stocks shine during inflationary times. While their share prices might not surge as aggressively as growth stocks, value stocks generally exhibit lower volatility, making them less prone to sudden price drops during market downturns. Additionally, these stocks usually boast strong financial performance, often trading at lower prices relative to their underlying fundamentals. Consequently, value stocks offer a cushion against downside risks during inflationary periods, attracting investors seeking stability amid economic uncertainties. This makes them a preferred choice for those prioritizing stability in their investment portfolios during inflationary periods. Bonds. Bonds often struggle during periods of high inflation due to the inverse relationship between bond prices and interest rates. When inflation rises, central banks usually respond by hiking interest rates to rein in the increasing prices. As interest rates climb, the value of existing bonds decreases because new bonds issued offer higher yields, making older bonds less appealing. This inverse relationship creates a challenging scenario for bond investors during high inflation periods. If you're seeking stability in your investments during these times, traditional bonds might not be the most favorable option due to their susceptibility to losing value as interest rates rise. However, there are exceptions to this rule. Some specialized bonds, like I-bonds and Treasury inflation-protected securities, TIPS, have shown resilience during inflationary periods. These bonds are designed specifically to shield investors from the erosive effects of inflation. For instance, TIPS are government-backed bonds designed to shield investors against the erosive effects of inflation. These bonds' uniqueness lies in their ability to safeguard the purchasing power of your investment during inflationary periods. Here's how TIPS function. When you invest in TIPS, you essentially lend money to the government. In return, the government commits to paying you annual interest payments along with an additional payment at the bond's maturity. This extra payment adjusts based on the inflation rate. The beauty of TIPS lies in their responsiveness to changes in inflation. As the inflation rate climbs, the value of your TIPS investment also rises. This adjustment helps protect your investment against the eroding effects of rising prices. Moreover, TIPS are considered very safe because they're backed by the U.S. government. This backing provides investors with a high level of security and assurance of repayment. In summary, TIPS serve as a reliable tool for investors seeking to shield their investment portfolios from the adverse impact of inflation. They offer a secure way to maintain the purchasing power of your investments during periods of rising prices, making them a favorable choice for those looking for stability amid inflationary pressures. Similarly, I bonds, also known as inflation index bonds, can be an ideal investment if you're concerned about inflation eroding your savings. These bonds are designed to combat the effects of inflation, ensuring that your investment retains its value even as prices for goods and services increase. The unique feature of I bonds lies in their ability to keep pace with inflation. As prices rise, the value of your investment adjusts accordingly, safeguarding your purchasing power. While I bonds might not offer high returns compared to some other investments, they provide a reliable assurance. You're likely to at least recoup your initial investment, making them a low-risk option for safeguarding your savings during periods of inflation. Moreover, I bonds offer a sense of security as they are backed by the U.S. government. This backing ensures that your investment is safe and protected, providing investors with confidence in the stability of their funds. In summary, I bonds serve as a low-risk strategy to shield your purchasing power from the impacts of inflation. They may not provide exceptionally high returns, but their ability to adjust with inflation and the security of being government-backed make them an attractive option for investors seeking stability and protection against the erosion of their savings during inflationary periods. So, while conventional bonds may struggle during high inflation periods, these specialized bonds like TIPS and I bonds stand out as potential options for investors seeking stability and protection against the erosion of purchasing power caused by inflation. Commodities. Commodities like gold, oil, or agricultural products often perform well during periods of high inflation as they act as a safeguard against rising prices. Referred to as inflation hedges, commodities offer investors protection against the erosive effects of inflation on their investments. The commodities market tends to surge when prices rise, because producers can simply increase the prices of their products in response to high inflation. Since commodities are crucial in producing essential goods, demand for them remains relatively constant even as prices climb. Investing in commodities helps shield investors from the declining purchasing power of their money during inflationary periods. Additionally, commodities can serve as a valuable tool for diversifying an investment portfolio. They often move independently of other asset classes, such as stocks and bonds. This independence can provide a level of balance and protection to an investment portfolio, as commodities performance might not be closely tied to the performance of traditional stocks or bonds. For these reasons, including commodities in an investment portfolio is considered essential for effective diversification. They not only offer a shield against the impact of inflation, but also provide a means to balance and diversify investment portfolios, enhancing their overall stability and potential for returns. Real estate. Real estate, much like stocks, often performs favorably during periods of high inflation because property owners can adjust rents to offset higher costs without significantly impacting demand for housing. This ability to pass on increased expenses to tenants helps maintain the revenue from real estate properties despite rising inflation. However, it's essential to note that real estate is highly sensitive to changes in interest rates. If interest rates increase rapidly, it can adversely affect real estate values, even during periods of high inflation. An example of this occurred in the early 1980s when interest rates surged considerably. This sharp rise in rates led to a significant decline in real estate values, despite the ongoing high inflation at the time. In summary, while real estate tends to perform well during periods of high inflation due to the ability to adjust rents, its value is highly dependent on interest rates. Rapid increases in interest rates can have a substantial negative impact on real estate values, highlighting the delicate balance between inflation and interest rate movements in the real estate market. For investors, comprehending the performance dynamics of diverse investments during times of elevated inflation is pivotal in directing capital allocation. The primary objective lies in safeguarding the purchasing power of investments, necessitating a strategic selection of assets capable of preserving or appreciating in value amidst escalating prices. Treasury inflation-protected securities. Tips. Exemplify a proactive strategy. These securities diligently track inflation rates, offering investors a real return that adjusts to counter the erosive effects of inflation. Real estate emerges as another resilient asset class during inflationary periods, often witnessing an uptick in property values in line with the increased cost of living, making it a favorable investment choice. Commodities like gold and silver also gain prominence as inflation hedges. Their values tend to surge alongside rising prices, providing investors with a protective cushion against the detrimental impacts of inflation. Furthermore, I-bonds, issued by the U.S. government, stand out as an additional option for investors seeking a shield against the mounting prices that erode purchasing power. Lastly, value stocks exhibit a notable resilience in the face of inflationary pressures. Companies with robust fundamentals effectively navigate high inflation by passing increased costs on to consumers, thereby maintaining or even augmenting their value during such economic climates. In essence, understanding the nuanced performance of these varied investment avenues during periods of high inflation enables investors to strategically navigate and allocate their capital, aiming to fortify and preserve the purchasing power of their investments amidst the challenges posed by escalating prices. I recommend you watch the next video in our series. Don't hesitate to share this video, subscribe to our channel, and share your thoughts in the comments section. Thanks for watching, and Lil see you in my next video.